Well, employment in June and July combined is 21,000 jobs lower than what was previously reported. And joining me now to break down these numbers, what it means for you as an investor and as a spender, is Satyam Pandey. He's a chief U.S. and Canada economist for S&P Global Ratings. Satyam, thank you so much for joining the show this morning. What is your reaction to the August jobs report?
Well, it confirms what we had already started to see, that the labor market softened appreciably over the summertime. And there is both labor demand and labor supply factors, that are playing out. But it seems like, at least for now, the Fed is going to be cutting that 25 basis points in their next FOMC meeting.
Yeah, I want to talk about the jobs picture collectively. Obviously, we see the headline report today, but usually the first week of every month, we get a whole host of jobs data, right? Job openings and labor turnover, that survey and report, jobless claims, which we get on a weekly basis, and the ADP report. So collectively, cite some of these data points for us that cause you to think that the Fed will indeed move at its next meeting.
The first thing that sort of raises this yellow flag here is the distribution of job gains coming from the industries, right? So the share of industries adding jobs has really come down well below average. So that is the first thing that tells us, all right, the labor market has cooled off quite a bit, at least in cyclical terms. The second bit is the break-even, the employment rates have also come down because of the supply side issues, the number of people that are working, the labor force participation rate, whether it be because of immigration policies or just regular aging in the U.S.
I'm going to jump in, Satyam. We are going to send it over to the boardroom as we await remarks from e.l.f. Beauty here today to celebrate the opening bell. I do want to bring back my earlier guest, Satyam Pandey. He's an economist, of course, as we break down the jobs data this morning. Satyam, thank you for staying with us here, of course, during a big morning for the New York Stock Exchange. But we were discussing the jobs data and how it does show a weakening jobs picture. What does this mean for the Fed? How swiftly might they need to act due to these figures?
Well, clearly, the risks to more, employment becoming even weaker has increased. I think the Fed is going to cut in the next September meeting. 25 basis points is now done deal. There are talks about 50 basis points being a chance as well, but I think we shouldn't really get ahead of ourselves on that front. We still do have the inflationary pressures also building. So the Fed is likely going to take sort of a slow, step-by-step approach where, yes, let's go ahead and give this insurance cut this September, and then perhaps wait for some more data. But they are walking a tightrope here. They would probably want to get ahead of the inflationary pressures by cutting a few 25 basis points before that number starts to show up in the inflation. But our thought is that 50 basis points in the rest of the year, and perhaps a slow once a quarter 25 basis points next year. But again, it is really data dependent. Every FOMC meeting is live. I don't think data, policy rate cuts every meeting is an automatic.
All right, Satyam Pandey, Chief U.S. and Canada economist for S&P Global Ratings. Satyam, thank you so much for joining us, especially early on the West Coast this morning. All right. Thanks again.